why are those central banks, why are the Russian, Chinese, Indian, Iranian central banks loading up on gold so much? What do they know that we don't? What's coming? Well, they see the deterioration of the dollar. They see gold as a safe haven asset with 6,000 years of history. Gold is not like a company that can go bankrupt, all right? It's a commodity, and it always comes back.
Today, I'm excited to have today's guest here on Silver Doctors, first-time visitor, Mr. David Moadel. He's a market analyst as well as a commentator. Today, he's joining us to share his thoughts on the financial markets, the global economy, as well as a lot of other topics as well. So, David Moadel, welcome to Silver Doctors.
Thank you, Mike. I'm a huge fan of the show. It's a pleasure to be here.
Well, I appreciate you taking time out of your day to join us here. Looking forward to find out your thoughts from an investment standpoint, being that you look at a variety of markets or whatnot. But before we dive into some questions, give the audience a little bit of your background, how you arrived at your current position now of analyzing markets, investor, trader, and things of that nature.
Absolutely. Mike, I help a lot of people with finance. I help people to get away from the mainstream media narrative so that you can think on your own and you can be a self-educated investor. You don't have to hand your money over to somebody at Merrill Lynch, Bank of America, Wells Fargo, somebody like that, so that they can take 1 to 2% of your portfolio as a fee every year just to underperform the S&P 500, because 8 out of 10 of these money managers underperform the S&P. Why do that? You can do better than that. And I help a lot of people. I have a YouTube channel. Right now we have 34,000 subscribers, not too bad. And you could just go ahead and type my name, David Moadel, M-O-A-D-E-L, into the YouTube search box, and you'll find that I have over 500 videos free to watch and enjoy and learn all about cryptocurrencies, the dollar and how it's deteriorating, silver, gold, how there are opportunities there, and just some amazing stock market picks that have created a lot of wealth for a lot of people. And I'm going to continue to provide that education for people.
Sounds good. Now, so you mentioned on something I actually wanted to hit on, because as of this current moment, especially yesterday, rather, with the Dow Jones taking a little tank and a lot of volatility in the market, so a lot of people, I'm sure, are concerned. And so I know there's a lot of fear, but yet there's also a lot of opportunity out there for those that are aware and informed. But before we dive into the details of that, share with me a little bit of some things that are of concern to you, being that you watch the markets, you are helping people with their investment strategies and whatnot. What are some things that concern you that you're keeping an eye on the most?
Yeah, what concerns me is that right now we have a toppy market that's a very shaky market. We're seeing those big daily moves in the S&P 500. Like yesterday, we saw the S&P 500 go down 2.5% in one day. Based on what? Based on constantly, I would say skittish is the right word, a constantly skittish investor community. Every little tweet, every little back and forth, tit for tat between Xi Jinping from China and from President Trump is causing big market moves. So you could either try to follow and predict these market moves, which is not a winning game. That's responding to noise. Or you can look at the overall narrative. We have an election coming up, November of next year. It's coming sooner than we expected. Time just keeps marching on, and it's already a year and a half away until the next election cycle starts. We've got a president and a Fed who have no interest in tanking the stock market, and so what tends to happen is the president is going to, just like past presidents, just like Obama with Janet Yellen, they're going to want to do whatever they can to prop the stock market up. It's been working for 10 years now. We're 10 years into the longest bull market in American stock market history. The problem is they keep kicking the can down the road, devaluing the dollar, making it impossible to have a quote-unquote risk-free investment into bonds because they're paying around 2.4% per year. After you factor in inflation, you get next to nothing. So American investors, retirees, and savers are forced to pile into a risky stock market. It's herky-jerky, just follows around every little piece of news on this trade war. Is that the kind of market you want to be in? With PE ratios sky high, now you have to be not a blue chip index investor. You want to be a stock picker. And not just stocks. You also want to get into precious metals, at least part of your portfolio. I also like cryptocurrencies at this point. I love the way that they're making a nice rebound. It's not toppy because we've seen Bitcoin go up to 20,000 almost before. Now it's approaching 8,000 now. So I'm bullish on alternative assets, alternative investments. Don't buy into the mainstream narrative. Think on your own. Self-educate. That's what you and I, Mike, that's what you and I help people to do every day.
Right, I agree 100%. So one of the things you mentioned was being a stock picker. And so I've noticed myself over the last several years, especially since the Great Recession, how investing has somewhat become more of a get in, get out type of thing. For those that are in the know, they're able to actually pick some stocks and probably do well from a trading standpoint. But the majority of the population buy and hold. And I noticed yesterday watching some mainstream news channels as a response to the volatility, a lot of people were saying, just buy and hold, just ride this thing out. And I'm thinking, like, I wonder, is that same investment advice, is it safe? Is it the right thing to be telling people, given the fact that times have changed and the future is uncertain? What are your thoughts on that? And so I just wanted to get your thoughts on investment ideas, because the philosophy has stayed the same, but the environment has changed completely.
Well, the old school allocation of buy and hold, or 60-40, that's what a lot of mainstream analysts will recommend. It's an old school method of investing. Go 60% into the S&P 500, the Dow, the NASDAQ, something like that, and then the other 40% into bonds. We already discussed bonds. Right now, I've got bond yields at, the 10-year is at 2.41%. Again, when you factor out inflation, you're getting next to nothing. So it's not even a risk-free rate anymore. Bonds are toxic. Today, you've got the S&P 500 up 1%. Yesterday, down 2.4%. That's the kind of price action, full point daily moves that you see before economic downturns, before market crashes. Now, I cannot time it exactly, but I will say this. At the end of last year, there were numerous yield curve inversions, meaning that short-term bond yields in American bonds were higher than long-term bond yields. So, for example, you had the 3-month bond paying more to investors than a 10-year duration bond. That's not only bizarre and backwards. You're supposed to get paid more for longer term commitments than shorter term commitments. But also, whenever that happens, within 18 months, a year and a half, you're going to get an economic contraction. In other words, you're going to get a market crash of some sort. So that started about 5 or 6 months ago. So am I timing a market crash a year from now? You can't time these things that precisely, but it's happened very, very consistently. So let me ask you this, for anybody watching and listening to this. Would you have, if your parents are thinking about retiring, your grandparents are thinking about retiring right now, would you advise them to get into an decade-old bull market? Would you advise them to allocate into stocks and blue chip indexes and bonds right now with the yield curve inversion that just happened about half a year ago? I wouldn't. I wouldn't subject my loved ones to that, and I wouldn't subject myself to that. So buy and hold, you don't start at the top. You start after a sizable contraction. Yes, if you had gotten into let's say the S&P 500 in March of 2009, yeah, you'd be up 300%. Sure. But to get in now after a 300% relentless run-up, no, that's not the time to get in. And so, as we mentioned, you got to be a stock picker, and not just stocks. You've got to be an asset allocator, and you got to be very careful at this point in time.
Asset allocator. I like how you use that word there. Now you mentioned slowdown, and so ultimately a recession is around the corner. But given how this economic expansion has been artificially extended, what's the chance of, especially now we have President Trump who's requesting a cut rather, as well as some additional stimulus on top of that. I had imagined with the Fed now pausing things and reconsidering things. That do you see sometime this year, or the need for them to interject again into the markets to stave off from an actual recession down the line, given the fact that, as you mentioned, also we're in the presidential season as well?
Yeah, that's a great question, Mike. I mean, they're running out of ammunition. They're a one-trick pony. That's all they can do is first not hike rates and now cut them. Okay, but they can only cut them so far. The Fed under Janet Yellen brought the 10-year Treasury note rate or yield down to it was around 1.8%. That was in the summer of 2016. Could they cut it down to that again? Could they cut it down to zero or even negative? Well, we have an experiment with negative yield policy in Switzerland. They're experimenting with that in Germany, Japan. So they can cut and cut and cut, but they can only cut so far. And then what? So can Trump and the Fed chair, Jerome Powell, can they kick the can down the road for the next year and a half to get it through another election cycle? Yeah, probably. They could probably do that. They can prop it up for that much longer. Okay, so if Trump gets reelected, then what? I don't believe they can kick the can down the road for another 4 years after that year and a half. I don't think they can keep it up for that long. If someone else gets elected, then they're going to inherit that, just as Trump inherited the situation from Obama, from Bush, and so on and so forth. Okay, so I'm not getting into any political stance. I'm not blaming any one president, because this type of Fed policy has been inherited from president after president ever since Greenspan started with this quantitative easing type of policy. The seeds of that were sown and then really brought into full gear with Bernanke and Yellen. And now with Jerome Powell, who experimented with tightening and a little bit of fiscal discipline. He got lambasted by Trump in Twitter and in speech. He caused a 20% tantrum in the markets. So, of course, there was that U-turn in the beginning of this year when they said, you know what, we're never going to do that again. Sorry about that. No more rate hikes this year. And Trump wants a rate cut. Well, so far, when it comes to the Fed, what Trump wants, he seems to get pretty consistently. So can they kick the can down the road through the next election cycle? Yeah, possibly. That could happen. Does that mean that America and American investors are safe through the next election cycle? No, I would say definitely not.
Right, I'd agree. And then also, just to take it into the next thing, which I think will be a major factor in all of these policies that will be implemented or looked at, is this whole trade war. And so because of the president being very open on social media, and so every time he speaks or tweets something, the markets move, and it's all in reference to him trying to balance the trade. And so as a market analyst as well as a YouTuber commentator, how much do you follow that, and how important will that be in the decisions that the Federal Reserve makes, as well as the outcome of this, economic slowdown or expansion or whatever we want to call it moving forward?
Yeah, I don't believe it's possible to win a trade war for either side. I don't think China's going to be the winner of this. I don't think the United States is going to be the winner of this. We can balance things out a little bit, but the trade deficit, according to the latest numbers, latest data, is worse than it's been in a very long time. It's actually been getting worse. And that's not to denigrate what Trump is trying to do, but the American taxpayer is going to be the bag holder in this situation, and already is. Look, enough labor has been outsourced, enough jobs have been lost from America overseas, and not just to China, but to India, Pakistan, all throughout Asia. So we've already lost that war. Those jobs are not coming back anytime soon. We are never, in America, we are never going to pay our workers as little as they do overseas. We respect our workers a lot more. We pay them a living wage, comparatively speaking. We give them fairly decent benefits, comparatively speaking. That's not going to change anytime soon, nor should it. And so we cannot win that war. We can never really balance it. So what's going to happen for the jobs. Don't look for it to get any better. If you are in a field that is likely to either be lost, jobs lost through automation, through AI, machine learning, or through outsourcing, which is going to continue, then you've got to think about readjusting your career, brush up on your skills, educate yourself. Go into another field if necessary. But honestly, if you're into those manufacturing jobs, those particular jobs that are likely to get automated or outsourced, you got to start thinking about what's my next career, and start preparing now, because it's not going to get any better.
Right, I agree. Now, to hit further on the whole tariff situation and just play out some likely scenarios, because as of now, I think from the most recent response from President Trump, he referenced about China not being too aggressive with this retaliation type of thing. So what are your thoughts? Will this go tit for tat all the way until what point? And is there such thing as a breaking point where if China decides to sell, which I've heard they've hinted at selling U.S. Treasuries, how does that all play out? How will that impact the dollar? What will that look like back home amongst all the other issues we have going on?
Yeah, well, as you know, and as your audience surely knows, this is already in progress, the dumping of the treasuries, of the dollar, because those are both U.S. debt notes. And the United States is not, the American government and Fed are not known for repaying debts very well. So you've got Russia, you've got China, you've got India, you've got Iran. They're dumping U.S. debt notes in the form of the dollar and treasuries, and they're buying up precious metals. They're buying up gold especially. So what can you do as an investor? Well, prepare for further U.S. debt note dumping, because it's going to continue. I don't blame them, because again, why would you invest in a debt note from a nation that has 22 and growing $1 trillion of debt? That, the United States is never going to repay that. Let's be honest with it. So if you have all your assets in cash, it's okay to have some dry powder, but I wouldn't remain all in cash for very much longer, because it is a deteriorating asset class. If you're in bonds, same thing. Then you own U.S. debt notes from a notorious defaulter when it comes to debts. Yeah. So, why are those central banks, why are the Russian, Chinese, Indian, Iranian central banks loading up on gold so much? What do they know that we don't? What's coming? Well, they see the deterioration of the dollar. They see gold as a safe haven asset with 6,000 years of history. Gold is not like a company that can go bankrupt. All right. It's a commodity and it always comes back. For asset managers that believe in the S&P 500 so much, why don't they tell people that gold has handily outperformed the S&P 500 since the year 2000? They don't really talk about it all that much. That's why Mike is such, and your program is such an incredible resource for people, because you're bringing those facts to light that you won't see on your CNBCs, your MSNBCs, or even your Fox News. They have a narrative that is in line with the Federal Reserve, that is in line with the American government, and that's through multiple administrations. Again, no political stance here. I'm not a red state or a blue state. I'm a green state. I want to make money for you guys. Okay. So they're loading up on gold. Ray Dalio believes in precious metals. Some of the greatest fund managers, Jeff Gundlach, the bond king, he's loading up on precious metals. What does that tell you when the bond king's doing it? And those guys they're not dummies. They're multi-billionaires. So I believe in following the smart money. Or, you know what? You can follow the retail traders who are wrong 90% of the time. You can follow the mainstream narrative, which has their own agenda. Or you can stick with what Mike's been recommending, with his podcast, with his program, which is to diversify your portfolio. If I'm quoting you correctly, I know that you believe in getting into the alternative asset space as opposed to just buying into what the mainstream narrative is going to tell you to buy, because you're always going to be late to the party if you follow the mainstream news.
Very true, very correct there. Now, I want to get your thoughts on. Of course, we have all these things that are taking place now. Nations are moving, diversifying, getting out of dodge of debt instruments, and so because of that, there's more war drums beating about things happening, whether it be ships being supposedly being attacked by Iran, and then we got Venezuela, then we got North Korea, then we have all these different areas around this planet that seem to be hot spots right now for possibilities of war. What are your thoughts on that? Will there be a need to instigate a war to divert people's attention from other issues that are more financial based? What are your thoughts on that? Will there be a war anytime soon, or can we avoid that somehow?
I think that that's a definite possibility. I think Venezuela would be an easy target. You have a very unpopular leader over there right now, and the people are truly suffering over in Venezuela. I mean, their currency is worth almost nothing at this point. I think only Zimbabwe could compete with them as far as devaluation of their fiat currency. So you've got a horrendous dictator over there, and the problem is they took away everybody's guns. And once you do that, then it's all over as far as freedom, both financial and otherwise, is concerned. Once the populace gives up their right to bear arms, then the government has total control. And so it would be very easy for the United States to target them. There are plenty of dictators all over the world, but I believe they would be an easy target, and that would be a very handy way for the government to, as you aptly put it, to divert attention from the real financial issues that are going on here in the United States. We have our own fiat devaluation going on, not at the level of Venezuela yet, and I do say yet because it could easily get there. But yeah, I could see them being targeted for military strikes or at the very least economic penalties beyond what they've got going already. So what would that do? Well, to have a war, a winnable war, an easily winnable war right before an election cycle could be very useful. And so as a diversionary tactic, as a way to drum up patriotism, it's worked in the past, and why not do it again? The present administration really has very little to lose by doing that.
Now, as we draw towards the end of our conversation this afternoon, I would be remiss if I didn't ask you, given the fact you study a variety of markets and a lot of things out there that are opportunities for people to investigate for themselves and to look into further. Leave us with and share with us a couple things that have you excited about possible opportunities, whether it be, as you mentioned earlier, you mentioned the importance of gold and what's happening there. You said some individual stocks, and then you also said some cryptocurrencies. And so given the fact we're predominantly a precious metals audience here, but yet we all should be open to hearing about opportunities to investigate and study for ourselves. What are some things that have you excited right now to leave us with?
Sure. Well, right now we've got gold again under $1,300 per ounce. That is a heavy resistance level. It just keeps banging its head on 1,300. Once it breaks through decisively, if you're into technicals, once you see a weekly or better yet monthly candlestick on the candlestick chart break above and hold above the $1,300 level, I believe it's to the moon for gold. Silver has had trouble with that $15 per ounce level, same thing. Once you see the weekly or better yet monthly candlestick break and hold above $15 an ounce for silver, all bets are off. It's just going to keep going, in my opinion. I'm also looking at Bitcoin holding above 8,000. I think it's wonderful. Not so wonderful for people who bought around $20,000 per Bitcoin. So if you're that guy out there who famously mortgaged his house to buy Bitcoin when it was around 20,000, I feel for you. Okay. On the other hand, you made your own decision though. Yeah. So yeah, not a policy I recommend. Please don't mortgage your house to buy any asset class. All right. So I do like the fact that it bottomed out at around 3,200, and it's just been going up since then. This was in February when it bottomed out at that level. Right around the same time that Jamie Dimon and JP Morgan turned around, made a U-turn in their opinion of cryptocurrencies and the blockchain. Coincidence? I don't know. I'll let you decide. But that was around the time, I'm sure you recall that JP Morgan was all against crypto for a while, very harsh. And then suddenly February, they launch JPM coin.
Yeah.
You
Very
know,
timely. Very timely.
yeah, interesting. And then right at that time, Bitcoin bottoms out and starts its not so slow ascent from 3,200 thereabouts, now above 8,000. I like those technicals. As far as opportunities, you got to pick and choose your gold miners and silver miners carefully. Also, don't ignore palladium, platinum, all those. I actually like U.S. steel. Because once this trade war is resolved, and it will be at some point, it's not going to go on forever. We can't afford that. China can't afford it either. X is the stock ticker for U.S. Steel. If you get into miners, I like Hecla Mining. I like for a gold play. For silver, I like First Majestic Silver, which is led by Mr. Silver, Keith Neumeyer himself. I like, let's see, Sand Spring Resources is another good one. If you email me, if anybody wants to email me at David Moadel, Moadel, at gmail.com, I'll give you some of my favorite stock picks, as well as some resources, that you can look at so you can decide for yourself. I don't want to recommend anything to get anybody to, just go out and buy it. But what I do is I teach people how to have their own trading or investing plans so they can make their own decisions.
All right, sounds good there. So, David Moadel, I appreciate you for joining us here on Silver Doctors, and more importantly, I'll link your website at the bottom of this video here so people can find out more and get connected with you. It's been great having you join us here on Silver Doctors. Any last thoughts you want to leave us with before we sign off for this interview?
You got to keep listening to Mike's show, his podcast. It is a main source for me. Stay away from those, the mainstream narrative. Think for yourselves, folks. It's going to enrich you, not only on a personal level, but financially as well.